So I like to consider myself a dividend growth investor. I think it's one of the most reliable and consistent ways to actually get a good return in the market, and I want to prove it to you in this video. I primarily like to buy and hold stocks that pay me a dividend, but not only do these companies pay out a dividend, these companies also have a really good track record of actually increasing the dividend amount that they pay out. So for example, one of the companies that I own in my M1 Finance Roth IRA portfolio is Coca-Cola. Now, Coca-Cola has increased their dividend payout over the past 56 years, and just over the last 10 years alone, they have actually increased their dividend around 7.5%. So I am receiving money every single year just from owning some Coca-Cola shares. But not only am I receiving money every single year, the amount that I receive is actually growing. So what I do is I take those dividends and I then reinvest it into my portfolio to buy some more 3M or to buy some more Coca-Cola, and then I get more dividends until it's like a snowball effect where I just keep purchasing more and more. Now, there have been many studies and reports done for why this is one of the best strategies for investing in the market. What I want to do is I want to show you a strategy that most people on YouTube, as well as Warren Buffett, have actually suggested to new investors. So if you're watching this video, then you probably follow or you've seen some videos from some finance YouTubers. And what most of these finance YouTubers will do is they'll sort of tell you that a very passive way that you can get started investing is by investing in the S&P 500. Now, this is a really good suggestion because it gives you some diversification and it allows you to invest in an index that tracks the 500 largest companies in the United States. The number that most finance YouTubers as well as most articles will throw out that if you invest in the S&P 500 that you can expect a return of around 7% every single year. This is based off of the historical average of the S&P 500 over the past 100 years. However, that's not even including dividends. If you take a look at this chart, this shows from 1988 until 2012 based off of the different returns that you would have got if you had just reinvested your dividends. So you'll see right here, the blue line is the dividends reinvested, and the S&P 500 for the red line is just tracking the actual index price. If you would have invested $1,000 in the S&P 500 in 1988, you would have received $5,557. However, if you had reinvested those dividends, then you would be looking at nearly double that return at $10,635. That's nearly a 10% annualized return on your money, while for the other example, you would have just seen around 7%. So that's a spread of 2.75%. And that was back if you had started in 1988 in this example, when the dividend yield for the S&P 500 was a lot higher than it is today. If you actually look at the average for today, it hovers at around 2%. Normally it sits a little bit below that. But if you look at the chart for the S&P 500, you'll notice that the historical returns is actually not that much. And this little snippet that we can see at the end of the Google chart, you'll see that the S&P 500 does not really increase that much. And it wasn't only until later on that the stock price or the index price started to really shoot up. Now, for this example, it's only starting in 1988. However, the number that most people will cite and throw out in their videos and in their articles is that you will have received an annualized return of 7%. That's not even taking into account the insane dividend yields from the S&P 500 during this time. During the first half of the 19th century, the S&P 500 had some really crazy dividend yields. You'll see right here that the record high for a dividend yield took place in 1932 at 13.8%. And the historical average is around 4.4%, which is much higher than today's average, which is around, like I said, below 2%. So if you would have actually included all of these reinvested dividends into your investments, you could have expected to receive returns at around 10, maybe even 14%, which is double the annualized return which you would have received if you had just basically put all of your money into the index and had not reinvested the dividends. As the richest man in US history, John D. Rockefeller famously said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." And this was during a historical time when he was investing and he had his businesses running during the time when the S&P 500 had these insanely high dividend yields. So while you would have received an annualized return of 7% just from investing into the index, if you had just reinvested your dividends, you could have nearly seen an annualized return of double that. Now, 7% is good because it does beat inflation, as well as you can double your money in a relatively short amount of time. But if you just keep up with investing in blue chip companies in companies that have a history of actually paying out a good dividend and increasing that dividend. So making sure that these companies are not doing bad, making sure that these companies have enough money to pay out the dividend, making sure that these companies are not going to cut their dividend. If you're on top of your dividend investments and you're actually investing in good companies and healthy companies, then you can expect to see a much higher return, higher than 7%, maybe even higher than 10%, which is often the number that is quoted when people talk about investing in the overall market. So I hope I've proved to you today that not only dividend investing, but dividend growth investing is actually one of the most reliable and consistent ways to invest in the market. It's all about reinvesting your dividends and seeing it as a snowball effect. The more in money that you invest, the more shares that you can purchase, and the company that you're investing in should have a good track record of actually increasing that dividend, meaning that you're going to receive more money the next time, then it's going to be reinvested, and more shares and more money the next time. That is the whole philosophy behind this strategy and why I think it is so reliable and consistent. So thank you guys for watching. I hope you guys enjoyed the video. Tell me in the comments if I messed up here, if you don't agree with me, or if you would like to see more videos like this, and I'll see you guys in the next video.